All right, so I believe you can hear me. So starting with the name of Almighty Allah, it's Abdul Shukur from the 𝐸 School of Business and Finance and 𝐶 Center for Finance. So I warmly welcome you all in this excellent program, which is Diploma in International Financial Reporting Standards. So let's have a brief introduction about our platform, and then we will be having an introduction from the participants as well. And meanwhile, Sir Mian will be joining us in the session. So I believe you can see my screen as well. So Zishan sir, can you please confirm if you can see my screen?
Yes, Mr. Shakur, I can see it.
All right. So we have some other participants who are joining. So as well as our platform is concerned, so we have some national and international affiliations. So we are approved by Institute of Financial Accounting UK, Financial Modeling Institute Canada, and we are also approved by the ATHE UK for level 3 to level 7 qualifications, and we have affiliations with the ICMA in Pakistan, ACCA, University of Sialkot, Pakistan Institute of Finance Accountant, Bloomsbury Institute, London, and certain other universities and professional bodies as well. Just like recently, we have signed an MOU with Namar University in Pakistan, a public sector university. Now, a brief introduction that what we are doing. So basically, there are three fields in which we are working. One is the educational programs we are offering. Then we have the corporate trainings, and then we have the consultancy services we are providing for our clients in Pakistan and international markets as well. So as well as the programs are concerned, which we are offering, these programs include Certified Financial Modeler, Certified CFO, Diploma in International Financial Reporting Standards, Advanced Financial Analysis in Power BI, Data Analysis in Power Excel, Advanced Diploma in Accounting and Finance, and Associate Certified Islamic Banker, and all regulated UK level 3 to level 7, leading to top of bachelor program and the master program. And most of these programs are accredited and endorsed by the Institute of Financial Accounting from UK. So the second field we are working for is the corporate training. So in the corporate trainings, we are offering trainings to the clients in Pakistan, in Dubai, and Saudi Arabia in financial modeling and analysis, taxation and compliance, audit and assurance, financial management strategy, advanced Excel and Power BI, leadership and HR best practices, and some soft skills as well. And the third area we are working for is the services we are providing, just like the bookkeeping outsourcing, virtual CFO services, employee end of the year benefits, are the actuarial valuations. We are also offering services in IFRS implementation and consultation, financial model preparation, Power BI implementation, and Excel dashboard reporting. Recently, we are developing the ECL model for the microfinancing companies as well, on the basis of International Financial Reporting Standard 9 as well. And soon we will be launching that ECL model as well. So these are few of our clients to whom we have provided trainings in Pakistan and international, including PTA, OGRA, GT, EY, KPMG, Pepsi, Abdul Latif Jameel from Saudi Arabia, MVP Funds, and some of the other organizations as well. Okay. So these are few of the glimpses of the trainings we have provided in Pakistan and in international market as well. This is Mastering International Financial Reporting Standard from in Hyundai Motors in Pakistan by Mian. Then we have again Mastering IFRS in Dubai by Mian. And we have Mastering Financial Modeling in Karachi by me. And then we have certain other trainings and conferences in different cities of Pakistan. This is Finance Leaders Conference and the Finance Leaders Conference in Lahore and Karachi. These are few of other sessions. Okay. Right. Let me walk through very quickly. Okay, so we have a few of our upcoming programs, including Certified Financial Modeler, Advanced Analysis in Power BI, Certified CFO, and we have the Data Analysis and Dashboard Reporting in Power Excel as well. So these are the 4 programs which are coming in the month of August. So as well as Diploma International Financial Reporting Standard is concerned, So this is bit old data. So this is our 11th batch as well as the Diploma International Financial Reporting Standard is concerned. So we provide live interactive training methodology, comprehensive study material, along with the question bank as well, and trainer presentation along with annotations. And yes, you will have the opportunity to ask live questions from the trainer as well. Okay. Then let's have a brief introduction about the Institute of Financial Accounting UK exam information. You have two options. You can write the exam by ACCA UK or by the Institute of Financial Accounting UK as well. So as well as the IFA UK exam is concerned, normally after the training, we decide a date for the exam. And this will be an open book and online exam. We will be sending you the exam via the email. You have to complete and send us back for the marking and the checking. And exam can be handwritten, or you can also type the exam, your answer into your Word format or something like this. Okay. So as well as the exam pattern is concerned, there will be 5 questions of 2 marks each, 10 questions of 3 marks each, and then we will be having 1 question for 15 marks, 1 question for 20 marks, and 1 question for 25 marks. So this is the pattern of the exam basically, and the passing marks are 50%. All right. So as well as the trainer for this particular program is concerned is Mr. Mian, and he is a fellow chartered from Institute of Financial Accountants, Institute of Chartered Accountants of Pakistan, and he has more than 30 years of experience in teaching and training, and he has provided training in different part of the world, including Nigeria, Ghana, Egypt, Jordan, Lebanon, between Afghanistan, Sri Lanka, India, and Pakistan as well. And he has the hands-on experience as well as the international financial reporting standards are concerned. So there are some very important points as well as this particular badge or these classes are concerned. So the Zoom link will remain same for all the sessions throughout the batch period. And you can save this particular link, or you can also add this link to your favorites so that you can join the session using the same link. And after each class, we will be sharing the recording link from Zoom, and you have to download the recording in maximum 24 hours after the sharing into the WhatsApp group. So otherwise, the link will expire for that particular recording, and unfortunately, we will not be able to provide the recording again. So approximately after an hour of the class, once the recording has been uploaded to the cloud, we will be sharing the link into the WhatsApp group, and you can download the recording. Then you can also join the session 2 to 5 minutes before the time to check your logistic and provide an inconvenience. And to keep the session very interactive, you can write your question into the chat window, or you can open your mic after the permission from the trainer, or you can raise your hand as well if there is any question. All right. So this was a brief introduction about the session, about the platform, about the trainer as well. So now I believe we have Sir Mian with us. So sir, are you with us?
Yes, I'm very much with you. Thank you very much for the introduction.
All right, sir. Okay, so what do you say?
Okay, thank you very much. Thank you very much, Mr. Bishopur, for giving introduction and the brief about the activities at Lexicon. This is Mian with you. I'm trainer for this IFRS diploma course. This is our 11th batch. In fact, before I start, I just want to have a brief introduction of my audience for today. We have Mr. 𝐸𝐴𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻𝑒𝐻 then Hamza, Saif, and Walid. Appreciate if you can kindly briefly introduce yourself, starting from Ihsanul Haq. Your mic is on, please.
Yeah. My name is Ahmad. I have experienced more than 15 years to work in the industry and practice. Previously, I worked at Saudi Arabia in Securitas Group, Sweden. Then I moved back to England, and then I started work as a practice accountant. And here I have almost 3+ years as a practice accountant, and we are dealing small and large scale clients, and we are also doing audit work. As concerned to my education, I have done masters from Pakistan as an accounting and finance, and now I completed my ACCA from here, and hopefully it's the final stage of ACCA, and hopefully I will finalize the ACCA, and then I'm also member of IFA.
Okay, good. Players knowing about you, Mr. Ehsan. Okay, thank you very much. And
Thank you.
next I have Mr. Arif Iqbal.
Assalamualaikum, sir.
Walaikum salam.
My name is Arif Iqbal. I belong from 𝐸𝐴. I am working here in Saudi Arabia as auditor of account and financial affairs in the government of Saudi Arabia.
Good. And your basic qualification, please?
My basic qualification is M.Com with specialization in finance from University of Agriculture, Faisalabad.
Okay, M.Com. Good. Thank you very much, Mr. Arif Iqbal. Well, and after Mr. Arif, we have Lohita Viduranga.
Hi, sir. I'm Lohita Viduranga from Sri Lanka.
Good. How are you?
I'm very well.
And how is Sri Lanka doing?
These days we are getting back to normal, sir.
Great. I had been there twice.
Oh, really?
And yeah, Colombo and then Kandy, like that. Okay, good. So, what is your basic qualification?
Yeah, I have completed my bachelor's in BSc Finance, special degree at University of Sri Javardhanpur in Sri Lanka. And these days I am reading my master's MBA Finance at University of Bedfordshire, UK. Also, I have completed Certified Management Account, Australia and New Zealand. Yeah, that's all.
Good. Wonderful. So, players knowing about you. Next, we have Hamza Iqbal. Mr. Hamza. Okay, Mr. Muhammad Saif.
Assalamu alaikum, sir. My name is Muhammad Saif. My basic is CPA, MBA Finance, and Certified Fraud Examiners. Also member of IFA, and this one, the Certified Financial Modular course also I did from this Lexicon International. And previously I served Deloitte like 6 years, and currently I'm working in Qatar Foundation as accounts payable specialist.
Okay, in Qatar Foundation. Thank you. Okay, and next we have Walid. Mr. Walid. Okay, Hamza Iqbal has raised hand. Please, Mr. Hamza.
Hello, can you hear me?
Very clear.
My name is Mohammed Hamza Iqbal. I have completed my master's in accounting and finance from University of the Punjab, Lahore.
Okay.
In 2017. After that, I have gained the professional experience. Now, currently, I'm working as an accounts manager in an importer distributor setup in a local industry. I belong to Pakistan. Basically, I have to expand my profession. I have to convert my academic knowledge or degrees to professional certifications and like that. So that's the basic purpose to join this kind of certifications and so on.
Great, good to know about you, Hamza. God bless you. And
thank you.
Welcome. Mr. Walid is there. If Mr. Walid can introduce himself. Okay, and then I can see 𝐷𝐞𝐜𝐴. If I'm not wrong, yeah.
Assalamu alaikum.
Walaikum salam.
Hey, I just joined. I was in another session of this. एक सेकंड के अंदर इस सेशन को मैंने ज्वाइन किया, वेरी इंपॉर्टेंट सेशन. सो आई गेस ये इंट्रोडक्शन चल रही है.
Yeah, this is our introduction session. If you kindly introduce briefly yourself about your education and current responsibilities.
अच्छा जी, मैं चार्टर्ड अकाउंटेंट और इंडस्ट्री में रहा हूँ ज़्यादातर फार्मास्यूटिकल, और मुझे हर थोड़े अरसे बाद ये ख्याल आता था कि मैं IFRS किसी तरह रिवाइज कर लूँ. तो अपने ऑपरेशंस में हम रहते थे चीज़ों में, और देखते IFRS जो है ना, जब हमने एग्ज़ाम दिए थे तो वो चंद पर्चे होते थे. वो एक IAS जो है वो डोरी से बना हुआ मिलता था, ICAP से ना. तो 8-10 IAS थे, और फिर उसके बाद वो बढ़ते बढ़ते अभी आपको पता है 3-4 हार्ड बाउंड वॉल्यूम्स है. तो आई वाज लुकिंग फॉर अ वे टू रिफ्रेश, और एक तरह से नए सिरे से ही सीख रहे होंगे क्योंकि बिल्कुल ही चेंज हो चुका है ना सब कुछ.
जी थिंग्स आर मच चेंज्ड, और
जी
काफी नई चीजें आ गई.
बिल्कुल. जब मैंने अपने प्रोफेशनल एग्जाम दिए थे तो ये IAS 32 और 39 तो था, but that was also such a long time ago. So please consider me a blank student. मैं तो वहीं
not at all. We will be learning from you, Rizvi साहब.
ये तो आप प्रेशर डाल रहे हैं मेरे ऊपर.
नहीं, आपके प्रैक्टिकल एक्सपीरियंस.
हाँ बिल्कुल, आई विल
वैल्यूएबल फॉर अस, मच वैल्यूएबल फॉर अस.
यहाँ लगेगा कि कुछ कंट्रीब्यूट मैं कर सकता हूँ तो डेफिनेटली आई विल स्पीक अप.
Thank you very much, Rizvi sir. Your complete name is Sayyid Naveed Rizvi, am I right?
बिल्कुल.
Thank you very much. And Waleed, आप कह रहे हैं कि your mic is not working. I'll request you if you can rejoin. You can quit from this meeting and then rejoin, then see your mic starts working or not. Meanwhile, Nader Shah has joined us. Mr. Nader, if you can please briefly introduce yourself.
Assalamu alaikum, sir. Thank you, sir, for invitation for linking. Sir, my name is Nader Shah Nader. I'm from Afghanistan. I have done BBA from International Islamic University, Islamabad. Then I have done MS Finance from Bahrain University, Islamabad. Then I have done PhD in Finance from NUST University. Only I have done, sir, 1 semester coursework, then left because of collapse in Afghanistan's government. So that's the reasons.
So you are still following your pursuing your PhD?
No, sir, left because of not good situation in Afghanistan. And then I submitted my application for the NUST Islamabad. Then I will leave for the now.
Good luck for you.
Hello.
Well,
Hello.
yes.
Can we break for sorry to interrupt, but I'm fasting, so
okay, yes. In fact, in Karachi, you can take a break. In fact, I know you are from Karachi, and in Karachi it is your Maghrib prayer time.
Yes,
so please take your time. Meanwhile, I'll just simply go through the few basic things, and you can resume like at the earliest when you get free.
Okay,
please. Thank you. Well, Mr. Waleed, if you could rejoin, and if you can speak, just see if your mic starts working or not. Otherwise, no problem. Oh, well, thank you very much for the introduction session. Okay. In fact, our today's session is about IASB conceptual framework. And this IASB conceptual framework, before I start talking on this, I just want to give you a brief introduction about the IFRS. In fact, it is mostly confused that what is the difference between IFRS and GAAP. And then there is one more confusion that what is the difference between IFRS and IAS. I'll talk briefly about it first. In fact, historically, the financial statements were prepared by the accountants using their local gaps. Local gaps means each country or each jurisdiction was having its own principles and rules for accounting, which were based on their business conventions or tax related principles. So those were the local gaps. By the time in 1973, IFAC realized the need of accounting standards, and then Mr. Walid is saying that it's a hardware issue. Well, I studied ACC and currently working in sportswear manufacturing. Thank you very much, Mr. Walid. Thanks for your introduction. Well, so yeah, in 1973, IASC, it was formed, and IASC, International Accounting Standard Committee, from 1973 till 2001, they released 41 IAS. Then a board was formed, which was IASB, in 2001. Yeah, a board was formed in year 2001. From 2001 onwards, IFRS was released, and IFRS plus IAS are now considered as accounting standards. Okay, all the 41 IAS have been adopted by IFRS, and till now there are 17 IFRS. Just because of bringing harmony in accounting, this need was addressed by IASB, through which IFRS was taken up, and now from then onwards, the IASB is releasing IFRS, and all the IAS have been accepted by the IFRS. The thing is that when we say IFRS and IAS, it is the same. There is no difference between IFRS and IAS, I'll say. Altogether, IFRS includes these four things, which are International Financial Reporting Standards, plus International Accounting Standards, plus IFRS, and plus SICs. Okay. By the way, 17 IFRS have been released, out of which one IFRS has been superseded, which is IFRS 4, and its replacement, IFRS 17, has been introduced. It's about insurance contracts, and out of these 41, 13 standards have been superseded, 28 are there. So you can say that in a way, 44 standards are there which are being followed for accounting practices. Okay. These IFRS are the interpretations of the IFRS. When there is some ambiguity, that is put to the board, and then they give an interpretation about that. So 15 interpretations as to the IFRIC and 5 interpretations as to SIC are there to follow. Apart from these IFRS, IASB has also issued few more releases, which are in fact not IFRS. Among those is IASB Conceptual Framework for Financial Reporting and Practice Statements, PS1 and PS2. Today, I'll talk on this conceptual framework for financial reporting by IASB. And by the way, as to this PS1, which is about management's commentary, which provides management's view about the entity's position, performance, and progress, that what are the issues that management addresses there, and what is its focus or viewpoint on those, and how it has to like comment, and then making materiality judgment. So this is a brief about IFRS. When we say IFRS, IFRS covers 4 main areas. Number 1, recognition of the accounting phenomena. Number 2, measurement of the financial information. Number 3, presentation criteria or presentation classification in the financial statements. And number 4 is about the disclosures. So mostly, almost all the standards, they talk about these 4 areas, but yet there are few standards like related party transaction, that is about the disclosure only, like IFRS 7, that is also about the disclosures only, that is about financial instruments disclosures. So there are few standards which are about disclosures only, and almost you can say almost all of the standards, they cover recognition, measurement, presentation, and disclosure requirements. Here, I'll start talking about conceptual framework for financial reporting. This IASB conceptual framework is not a standard, first of all, but this is this much important document that you can say that it is mother of all the standards, rather mother of the preparers of the standards. Because it is a document which provides guidance for the IASB that how these standards would be developed and released. So it assists IASB to develop standards. It is not an accounting standard. It is a bedrock for IFRS. It's a blueprint, means it is a framework based on which the standards, when released, they seek guidance from this very document. But at the same time, remember that it does not override any standard. If in a standard something is like required to be followed, then the standard will override. For example, as to the measurement, as to the recognition criteria, let me say, as to the recognition criteria, IASB framework says that there are 2 criteria. If these met, then we can recognize that financial information. Number 1 is like reliable, measurement, and number 2 is probable economic benefits. These are the 2 criteria mentioned in IASB framework. But at the same time, what we see that IFRS 9 says for financial instruments, recognition criteria is when the entity becomes party to the contract. So the moment entity becomes party to the contract, that entity has to recognize financial instrument in its financial statements. So this is what like a contradiction between IASB framework and a specific standard. So what we see that IFRS 9, the requirement of IFRS 9 prevails, and it overrides the requirements or the guidelines provided in the framework. Well, the basic objective of preparing financial statements is that these should be general purpose financial statements, first of all. And being general purpose financial statements, it must address the financial position of the entity, means the economic resources and claims. Remember one very important thing over here. Economic resources mean assets. And claims include owner's equity and liabilities. So if you don't mind, this is in fact the basic accounting equation which provides us the financial position of the entity. Assets are equal to owner's equity plus liabilities. So assets are the economic resources, and owner's equity and liabilities are claims, because owner's equity is not a liability of the entity. Entity is not obliged to repay the amount received from the shareholders, whereas liability is an obligation on the entity. But both of these two have claim on assets of the entity. Well, the second thing that users of the financial statement seek from the general purpose financial reporting is performance. When we say performance, performance means profitability, means that we get subtracting expenses from the incomes. It is profitability. And performance also looks into the cash flow. Means performance means the profitability as well as cash flow of the entity. So what are the changes in the resources and the claims? Those changes in resources and claims ultimately produce incomes and expenses through which we get profit. And these changes in resources and claims ultimately produce cash in and outflows. So this is about performance. And then comes management's stewardship of the entity's economic resources. Again, this is
the information that users of the financial statements they seek from the financial reports, the general purpose financial reports. Along with this information, they also, these general purpose financial statements, these also cover the risks and uncertainties through disclosures. As per the IFRS, the disclosures of risks and uncertainties in fact provide guideline to the users that help them to take decisions about like becoming potential investors, or like for selling out the shares, or like for decision making either to lend this entity or not, etc. Then the disclosures of resources and obligations not recognized. Okay, resources and obligations not recognized. When we say resources and obligation, as I've told you, these are the assets and liabilities. The assets and liabilities not recognized include like probable assets. As per IAS 37, these assets are disclosed, IAS 37. And contingent liabilities, again, IAS 37. These liabilities are disclosed. Probable assets are disclosed and contingent liabilities are disclosed. And few commitments are also disclosed. So these are the assets and obligations which are not recognized but are disclosed for the better understanding of the users of the financial information. Then geographical and industry segments, these are also disclosed, and effect on the entity of changing prices, that is also disclosed. In fact, this is the concept which is covered under capital and capital maintenance. Okay. And then in terms of like hyperinflationary economy, this is something that we disclose in that circumstances. So these are the objectives of the general purpose financial reporting. We can sum up that framework addresses decisions to provide resources to the entity. In fact, these are the three users of the financial information who are provider of finance. And these provider of finance are the primary users of the financial statements. They have to take certain decisions like buying and selling or holding equity shares or debt instruments, providing or settling finance, voting or influencing management for certain actions. So ISP framework addresses all these issues through general purpose financial statements. And then disclosure about the risks and uncertainties, as we discussed later, about the claims, changes in the resources, claims, efficient and effective management of the entity's economic resources. All these are in fact disclosed in the general purpose financial statement so that the financial statements are understandable and dependable, reliable. Well, the primary users are investors, lenders, and the creditors, as I have already discussed. The rest of the other users are the users of entity, but look, these are the three users who are provider of finance. Therefore, these are very sensitive provider of finance. Even existing or potential. all these users, they use financial statements frequently. Whereas the suppliers, customers, government agencies, employees, public, they also use financial statement, but the sensitivity for these users is not that high comparing with the primary users. Well, so these are the users which are addressed in IASB framework. Then IASB framework discuss very important area at the financial information which is placed in the financial statements should be of quality. When we say quality, means there should be some characteristics for that quality. Means there are some fundamental qualitative characteristics, and once those met, then enhancing qualitative characteristics which enhance the quality of the financial information. Look, first of all, relevance. Relevance means relevance to the decision making. The financial information which is presented in the financial reports should be relevant to the decision making. When we say relevant to the decision making, we have to see that what in fact makes the information relevant for decision making. There are two factors. One, predictive values, and the second, confirmative. Above all, the information which is in fact relevant to the decision-making point of view should be material. Means immaterial information can never be relevant to the decision-making. And when we say predictive and confirmative values, it means that the information on which potential investor or potential lender or potential creditor is focusing should be predictive, or if that is an existing investor or existing, you can say the lender or existing creditor, the information on which it is depending should be confirmative, or even both values should be there. Let me give you an example over here. Supposedly, there is a potential investor. He wants to take a decision for making investment in an entity. Making investment. So while taking this decision for making investment in an entity, it is focusing on dividends, supposedly. He is of the viewpoint that he will invest in that entity which will be paying dividend, and the dividend should be compatible as comparing to the market. The financial statements of an entity shows that this entity is paying dividend more than the market rate. Okay, so based on that, this potential investor takes decision and invests in that entity. Means this dividend, which it was like appearing in the previous balance sheets of the entity, is carrying predictive value. Okay, predictive value. Now what happens after a year? This investor observes that the entity has really declared a handsome amount of dividend and bonus shares. Now that dividend and the bonus shares are carrying confirmative value because the investor who has become an investor, earlier it was the potential investor, that investor can confirm through the dividend that this entity is capable of carrying his investment and paying the rewards to his demand or expectation, you can say. So the financial information should be relevant. You can say that in terms of relevance, the financial information means the information which is carrying predictive and confirmative value and material as well. Could be about the potential earning, per share, could be about the debt equity ratio, because all these are in fact the indications which make the information carrying predictive value or confirmative value, or you can say the return on capital employed, etc. Okay, so these are in fact the indicators through which you see that the information is relevant or not. Then comes faithful representation. Faithful representation means the information which is presented in the financial statements is reliable. Why it is reliable? Because it is faithfully represented. It has fulfilled all the policies and procedures and documentations and approvals accordingly. So it is complete in itself. It is neutral, not biased, not for the benefit of a certain group, and it is free from error. That's why it is reliable. So these are the two fundamental qualitative characteristics based on which the user of the financial statement, especially the investor, lender, and the creditors, they take decision. Once the information is carrying fundamental qualitative characteristics, then the user looks into the enhancing qualitative characteristics. Enhancing qualitative characteristics include comparative. The information should be comparable. When it would be comparable? When policies and classifications are consistently being followed. Then the information is verifiable either through direct or indirect methods, and which is timely available, and understandability established when you provide disclosures and the user is carrying proper knowledge base. Above all, when you are looking into the qualitative characteristics, you should not forget about the cost-benefit analysis. The management will never make expenditures for which the management cannot reap benefits. So the cost constraint is always there. That if, like, supposedly in order to make the information reliable, management need to spend money on that which is not of that benefit, management will stop spending money on that area. So cost benefit analysis is there. So I have talked about it, confirmatory value and predictive values. This is important, on which we will see there are 3 steps process for application of fundamental qualitative characteristics. First of all, identify the economic phenomena. In order to understand these 3 points, just keep in your mind that you are going to do accounting for provision for gratuity, supposedly, or provision for warranty, or any dividend, etc. Whatsoever, and any accounting phenomena you can take example of. Like identify the economic phenomena. By the way, when we say economic phenomena, there are 3 sources of economic phenomena. This economic phenomena is accounting phenomena, in fact. There are 3 sources of it. Number 1, transaction. Number 2, other events. And number 3, conditions. Okay, this is as per IASB. These are the sources of financial information. Any financial information which is popping up through transaction, events, or condition is your accounting phenomena. So you have to identify which accounting phenomena you are going to work out for making it qualitatively dependable. Okay. Well, then, as I have taken provision for gratuity, then identify types of information about the phenomena to be most relevant and faithful. Which type of information is required? Means the number of employees who are eligible for the gratuity, then their basic pay, their last drawn pay, their scale, blah, 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 blah. And then determine availability of information that could be faithfully represented. So when you work out all these things, in that way, you can say that the information is relevant for the decision maker, because it is then the information on which the user of the financial statement can depend. And above all, materiality is important. Then faithful representation, as I've already discussed, that faithful representation is affected by the level of measurement uncertainty. If your faithful representation is negatively affected, ultimately the measurement of the financial information will not be reliable. So faithful representation makes the financial information reliable in terms of measurement. Measurement means to give value. Obviously, error affects the value, neutrality affects the value, completeness affects the value because of all like documentation and processes. So this is how the fundamental qualitative characteristics work. Then comes enhancing qualitative characteristics. The accountant must look into it also, so that there is no compromise on making the information comparable, verifiable, timely available, and understandable. Very important point to share with you is that enhancing qualitative characteristics, these either individually or collectively, cannot render information useful if that information is not relevant or not represented faithfully. Means if fundamental qualitative characteristics are not there, we cannot say that in this comparability, verifiability, timeliness, and understandability can enhance qualitative characteristics. So if we want to enhance qualitative characteristics, first of all, we have to make it relevant and reliable, I'll say. Means represented faithfully means reliable, relevant and reliable. Only thereafter, comparability, verifiability, timeliness, and understandability can be established. Okay, the next thing which is addressed by this IASB framework is very interesting. That is, first of all, what is reporting entity? Reporting entity concept is addressed in IASB framework. Reporting entity is required, or it chooses to prepare financial statement, whatever the entity which has either required by the regulator, regulator asks an entity to report, that will become reporting entity, or an entity by itself volunteers to prepare financial statement, means that would be a reporting entity. Okay. Since it is a reporting entity, now it is not necessary that it should be a legal entity. Reporting entity means it is a reporting entity. It should not necessarily be a legal entity or a portion of an entity or more than one entity, etc. Entity means any organization which is either obliged to report financial statements by its regulator or by itself as voluntary. Okay, so reporting entity is reporting financial statements. Those financial statements could be individual financial statements or separate financial statements or consolidated financial statements. So in fact, when financial statements are prepared, we have to identify on the title that supposedly statement of profit loss belongs to a group, means it's a consolidated financial statement, or it is the financial statement of individual, or these are separate financial statements. Remember, the entity which does not hold investment in subsidiary, associate, or joint venture prepares individual financial statements. Suppose your entity is not having any investment in subsidiary company or in associate or in joint venture. So it means the financial statements that you will prepare would be individual financial statement. Number two, if your entity has made investments in joint venture, subsidiary, or associate, but as per IFRS 3, these combinations, IFRS 10, these combinations are exempt from the preparation of consolidated financial statement, then they would be preparing separate financial statement under IAS 27. So IAS 27 applies over here then. IAS 27 says that now you would be preparing separate financial statements, and in those separate financial statements, the measurement basis for investment in subsidiary, etc., would be as per the requirements of IAS 27. And consolidated financial statements are prepared as per IFRS 10. These are the group financial statements in which parent company and subsidiary companies' financial statements are merged together as per the rules and criteria defined in IFRS 10. So this is the concept of reporting entity and financial statements addressed in IASB conceptual framework. Well, now comes an underlying assumption, which is a basic logic, or which is an underlying assumption for all the accountants, that the entity for which they are preparing financial statements is a going concern. Because if the entity is not a going concern, you cannot apply standards on that entity. Therefore, it is taken as a unifying theoretical structure and as an internal logic of accounting, that it is a rule of game that the entity is a going concern. It is assumption that business unit will remain in existence for the foreseeable future. So this is an underlying assumption, the only underlying assumption of accounting for accountants for preparing financial statements. Well, there are 5 elements of financial statement, remember. Not 6, not 10. There are only 5 elements of financial statement. By the way, the financial information which I have just addressed, like that is accounting phenomena or economic phenomena, and the source of which is transactions, events, and conditions. Those financial information are classified into 5 main heads. Those are assets, liabilities, equity, incomes, and expenses. Confusion arises when there are certain heads of accounts are accounted for, which are not in fact asset or liability or equity or income or expenses. Then a confusion arises. But matter is very easy. We just have to relate those heads of account as contra to the relevant main head. For example, allowances for irrecoverables. These are not liabilities, okay? But these are contra to asset. These will always be subtracted from the relevant asset. Accumulated depreciation. This is again contra to asset. It will be always subtracted from its related asset. So the main head of account would remain with the asset, but they will be considered as contra to asset. Then against equity, we see treasury shares or accumulated losses or drawings in terms of like honors of sole proprietor or partners. Again, these are contra against equity. Contra against equity means these will always be subtracted from the owner's equity, like treasury shares. Treasury shares means investment in own share capital. Okay. When the entity will make investment in its own equity shares, that investment would not be termed as an asset. Rather, that would be termed as contra against equity. It will always be subtracted from the owner's equity. Accumulated losses, again, this is an item of equity, but would always be negative. Drawings for sole proprietors, it is contra against equity, or it is always subtracted from the relevant head of accounts of the owners. Then there are few examples of contra against incomes, like sales return and discount on sales. Remember, when we say discount on sales, this discount on sales is in fact expense. Okay. But there is a requirement that this expense may be subtracted from the sales income, which is discount allowed. So there are 2 treatments to this which are genuinely correct. Either we consider it as an expense item, then it would be coming under that expense head, or we can subtract it from the sales income. In that case, that would be a contra against income. In the same way, purchases return and discount on purchases or discount received. Again, this discount on purchases or discount received can be termed as income item or a contra against expenses. All right. Well, so this is all about the 4 elements of financial statement. Now, briefly, I'll introduce the definition of this assets and liability, expenses and income very briefly. Like assets are present economic resources. These are the present economic resources. Present means the reporting date. On reporting date, when we are preparing balance sheet, on reporting date, we see that these are the economic resources which are controlled by the entity. And as a result of past event, because in the past, the entity had entered a contract or the entity had purchased some plant and machinery, because of which this is an asset. The important thing is that economic resource means a potential to produce economic benefits. So when we say potential, potential means future. So any resources which are on the reporting date with the entity means in the control of the entity, and for which entity assumes that it is carrying a potential to produce economic benefits in the future, that would be termed as an asset. So there is nothing about the ownership. It is not mentioned here that the asset are the resources in ownership of the entity. No, in control of the entity. Means the entity has power to obtain economic benefits from these resources. In fact, leasehold assets are not owned by the entity, but are in the control of the entity. Therefore, those are assets. Like right of use assets is an asset, although there is no ownership on that. So broadly speaking, assets are classified into financial and non-financial assets. Okay. Financial asset means the asset which is generated based on a contract and because of which the other entity would be having a liability or equity. Okay. These are the financial assets. Then further, these financial assets can be classified into current asset and non-current asset. That's another story. In the same way, the non-financial assets are the assets which are not generated because of some contract. And these are, in fact, the asset that are providing economic benefit to the entity currently and in the future as well. These can also be subclassified into current and non-current assets. Okay, like inventory, like land and building, like investment property. These all are non-financial assets because these do not give rise to a present right to receive cash or another financial asset. Okay, land, building, plant and machinery are the examples of non-financial assets. So by the way, either you subclassify asset into current and non-current asset, and then each current is again subclassified into financial asset, non-financial asset, and in each non-current asset is further subclassified into financial and non-financial asset, or you classify originally as financial and non-financial asset and then subclassify into current and non-current, current and non-current. Okay, so whatever. But remember this classification for the assets. The same, we classify liabilities. For liabilities, remember, these are the present obligation. Again, present means the reporting date. On reporting date, the entity is obliged to settle this liability in the future. because it was arising from past. And this is an obligation that the entity has no practical ability to avoid. So this liability is further subclassified into financial liability and non-financial liability. And again, the same story, the financial liabilities are further subclassified into current liability and non-current liability. And these non-financial liabilities are also subclassified into current liabilities and non-current liabilities. By the way, almost all the liabilities are financial liabilities. Almost all the liabilities are financial liabilities, except very few. Those very few include deferred tax liability and government grant deferred income, because liability means you have to pay someone, means the someone will be receiving from you. So it means the other party is having an asset because of your liability. So mostly liabilities would be financial liabilities. Okay. Equity. Look, when we say equity, again, the basic equation, assets minus liability is equal to the owner's equity. First of all, remember, which is a misconception, that mostly people say that owner's equity is a liability. No, not at all. Owner's equity is not a liability. Then people say owner's equity is a liability payable to the owner. Wrong concept. Owner's equity is not a liability payable to the owner. In fact, owner's equity is never payable. Is never payable. You have, in fact, established a right on the net assets of the entity because of this owner's equity. This is a message. Thank you. Thank you. Okay. So this assets minus liability gives a right to the shareholders, to the owners, on the net assets. So it's a claim. It's not liability. It's a claim of the owners. Claim of owners on the net assets of the entity. Now see, today, whatever the assets, whatever the liabilities, the net is for the owner's equity. After a year or 10 years, assets minus liability, liability would remain same, will give you the right to the owner to claim whatever asset has grown up. Okay. Whatever the growth or the decline the business enjoys is ultimately transferred to the owners through this concept of owner's equity. Okay. So broadly speaking, owner's equity includes the shareholders' capital, the retained earnings, and the reserves. These reserves are in fact the setting aside the profits for some specific task or for capital maintenance adjustment or for general purposes, whatever the purpose, that belongs ultimately to the owners. Okay. Well, income. All right. Again, about income. Remember, there's a very simple definition of income. Before discussing the definition, let me give you a small accounting entry, which is very easy to understand. Cash debit and sales credit, 1 point. Then means cash or debtor, whatever. Then the other. When you pay off liability, creditors debit, and you pay off liability by making cash. And if the liability was for 100, you are paying 90, that 10 you are getting discount received. Okay, keep these two accounting entries in your mind and now read these lines. Income is a gain of economic benefits during the reporting period in the form of, inflow or enhancement of asset. Here we go. Inflow or enhancement of asset or decrease in liability. There we go. So this is the simple definition of income. Because of this income, look, this is the income, there would be inflow or enhancement of asset, or there would be a decrease. Look, these definitions are not made by myself. These are the definitions written in the standard, IASB framework. So these are the very basic definitions on which financial statements are built. So income is decrease in liability. You are paying off liability and having this discount received as your income. The next thing is very powerful, which ultimately results in increase in equity, because now this increase in asset will result in increase in the equity because it will generate profits. And those profits will become part of equity. But this sentence removes all the ambiguities which were created based on the above sentences. Like, supposedly, without reading this line, I say, suppose this framework is saying that increase in cash flow, okay, let me debit increase, and loan is credit. So should I take it as income? I'll say no, because it is not ultimately increasing the equity. Okay, then I say, okay, if you want to say that it should increase the equity, let's say cash debit and share capital credit, should we take it as income? Because it is ultimately increasing the equity. The next sentence takes care of it. Other than those relating to the contribution from equity participants. So it means this is also eliminated from income point of view because it is increasing the cash flow, but it is other than those relating to the contribution from equity participants. Very strong words which are used in this definition. I've explained this. The next thing which is very important to understand, this is my interpretation now. Income is subclassified into revenue and gains. Revenue is the basic revenue stream for which the entity was established. It is in fact the ordinary course of business. For example, your entity was established for selling your services. So selling your services is your basic income. So that is your revenue. Then comes gains. Gains are of two types. We can classify gain into two, realized and unrealized gain. Realized gain includes the gain by selling asset at a price greater than their book value. Means you had an asset for a value of 100 in your books that you have sold for 170. The 70 is gain. That is not revenue. That is gain. Or by settling a liability at an amount which is lesser than its book value. So again, the liability which is settled at a value lesser than its book value. This is the example. The book value was 100 and you settled this liability by paying 90. 10 is your gain. All right. So income includes revenue and gains. Well, this is the example of realized gains. Now, this is the example of unrealized gain. Unrealized gain means holding gain. What is holding gain, by the way? Holding gain means you had a building appearing in your balance sheet for 100 million, and now you are revaluing it at 170 million. That 70 million is a gain that occurs just because of holding that building over the years in your balance sheet. So that's a holding gain, which is in fact the revaluation of assets, property, plant, and equipment, or remeasuring the financial instruments, or remeasuring the investment properties. Okay, so how to treat this unrealized gain? It depends upon the requirements of relevant standard, because IAS 16 says that this unrealized gain should be measured in equity through OCI. IFRS 9 says that the investment in financial instruments should be measured at fair value through OCI, or there is a category which should be measured at fair value through profit or loss. IAS 40 says that investment property should be measured at fair value through profit or loss. So look, again, this IASB framework is just providing us guidelines, and the standards will override these IFRS, this IASB framework, sorry, the standards, the IFRS, they will override this, because the standards will be giving us guidelines or the principles, in fact, relevant to the circumstances. So that would be the mainly requirements to be followed. All right. So this is income. Now expense. Again, expense arising from ordinary activity and losses. Both are expenses. And those losses are again subclassified into realized and unrealized. But before going through this expense, just look into its simple concept. Expense is like expense debit and cash credit. It is an expense. Or expense is expense debit or liability credit, if it is payable. So expense would be either depleting the asset, or it will cause an incurrence of liability. This is expense. So very simply defined in the IASB framework, that expense is a consumption of economic benefits. Consumption of economic benefit. Like, what is depreciation? Depreciation is consumption of economic benefit. Okay. What is like amortization? Consumption of economic benefit. In the same way, leave compensations or leave salaries, consumption of economic benefit. Okay. So consumption of economic benefit that belongs to the reporting period in the form of outflow or depletion of asset or incurrence of liabilities expense, again, which ultimately results in decrease in equity, or other than those relating to distribution to equity participants. Because when we distribute equity participants, the entry is dividend, debit, and cash credit. It is saying that it is not expense. Dividend payment is not expense, very clearly mentioned in IASB framework. It is distribution of equity. Or if we are saying that we are paying off a loan, okay, that loan payment is not ultimately decreasing the equity. You are paying off a loan liability. It is not decreasing the equity. So these two are not expense. This is expense because ultimately it is causing a decrease in the owner's equity. Expense can further be split into two ordinary activities, which are expenses for the year. Losses are realized, unrealized. Realized losses are by selling the asset or by paying off the liability. Means selling the asset at an amount which is lesser than its book value and paying off the liability at an amount which is greater than its book value. So would be a realized loss. Unrealized loss, which arises because of remeasurement, and how to account for that remeasurement depends upon the relevant accounting standard. Because IAS 16 says that revaluation loss should be taken to statement of profit loss, but IFRS 9 says that remeasurement loss for the investment which are remeasured at fair value through OCI should be taken to the owner's equity through OCI. So it depends that which standard you are following for working out or accounting for the unrealized losses. Very well. An expense is recognized immediately when it produces no future economic benefit. Means it has been impaired. When asset has been impaired, there is no future economic benefit, should be expensed out. When a liability is incurred without recognition of an asset, expense. There is very beautiful concept of unit of account. Unit of account. So, okay. Unit of account means the unit at which you work out the recognition. Before I discuss this unit of account, I will make these two concepts clear to you. Rights means rights on the resources, means assets. And obligation means liability. Okay. The unit of account is the right or the group of rights, right? Or the group of rights. The obligation or the group of obligation. So what you can say that unit of account, either you are buying a plant and machinery, a single item, or a group of similar characteristics. That would be a unit of account. Sometimes what happens for the banking sector, there's a portfolio. That portfolio carries similar characteristics. Okay. So based on that similar characteristics, those become a group of obligation or a group of assets. Okay. Or the group of rights and obligations. Now, group of rights and obligations means a division or to be precise, a subsidiary company. When you buy a subsidiary company, you buy assets and liabilities of that entity. So that is a group of rights and obligations. Okay. So those are in fact the unit of accounts to which, this is very strong sentence, to which recognition criteria and measurement concepts are applied. So remember, in fact, the game is about the recognition and measurement. Okay. That how to recognize these rights and obligation thing, and at which amount these rights and obligations should be recognized. Either those are individual, group, or a group of assets and liabilities. The unit of account is selected to provide useful information. Their selection is required to make the information useful for the users. In determining the appropriate unit of account, it is necessary to consider whether the benefits arising from selecting the unit of account justify the cost of, again, cost benefit analysis. The unit of account include individual rights or individual obligations, all the rights, all the obligation, or all rights and obligation arising from a single source, means a contract. You have entered into a contract, and based on those contracts, you are having exposure to or a right of the variable returns. So it means you are having a investment in subsidiary, because this is something through which control is established. Okay. A group of those rights and obligations, for example, subgroup of rights over an item of property, plant, and equipment for which the useful life or a pattern of consumption differ from those of the others, means the similar characteristics as I was saying. Or risk exposure, in this case of portfolio management, same risk type investments or same type of risky deposits are in fact classified in a separate portfolio, so that we can say that the entity is having a unit of account which would be measured in the same way or recognized in the same way. In fact, this unit of account concept is used when we impair the assets. Impairment of asset. So impairment of asset we will discuss inshallah in IAS 36. Okay. Here we go. IASB framework also talks about the recognition criteria. Noor Ashraf is saying that आवाज बिल्कुल भी सही नहीं आ रही. Can someone confirm that my voice is clearly audible or not? If someone can confirm, please. Mr. Arif, Fazal, Ihsan. Am I clearly audible or not? Can someone confirm, please? Mahnur Ashraf is saying that I'm not clear. Mr. Rizvi, can you please confirm?
जी बिल्कुल सही आ रही है आवाज मुझे तो.
Okay, thank you. I guess Mahnur, kindly you can quit and then rejoin the session. I guess there is some issue in your device. Please. Mr. Fazal is saying it's better. Arif is saying clear. Okay, thank you very much. So let's proceed for this recognition. Okay. So in fact, again, the basic concept. Recognition means identifying correct accounting head while preparing voucher. It's a very technical thing when we are doing bookkeeping, very technical thing, because mostly in our team, this is the work which is done by some juniors, and mostly they do mistakes in this. What is the mistake? Wrong accounting head is debited or wrong accounting head is credited. This is recognition. So while doing recognition means while identifying the correct accounting head or the code for debit and credit, we have to see the criteria is met or not. There are two recognition criteria. Number one, probable future economic benefit associated with the item will flow to or from the entity. And the second is that the cost of the value that can be measured reliably. If any of these two criteria is not met, the recognition criteria would be not fulfilling the debit or credit of that specific accounting head. Supposedly, I have purchased a table. Now, a junior accountant will at once see that, look, it's a table. He will debit the asset. The thing is, just have a look on these two criteria. For this table, we have to look into the probable future economic benefit. These are associated with the table. Might be this table will be used by the watchman, and the table is exposed to sun and light and rain and like this, bad or good weather. So it means we are estimating its useful life lesser than 12 months. So now, see, should we recognize it as debit to asset? No, not at all. It should be debited to the expense. So not being table, it fulfills the criteria. Rather, the criteria is that is it probable that future economic benefit associated with this item will be more than 12 months or not? So again, the fundamental qualitative characteristics. We saw there were two, relevance and reliability. Reliability is faithful representation. So relevance may be affected by low probability of flow of economic benefit. Means the flow of economic benefit was lower, lesser than the 12 months. Therefore, should have been taken to expense. Recognition will be different if the probability of economic benefit is lower, or existence of certainty. If the existence is not long term, then that should have been taken to expense. So relevance means the user is taking economic decision based on this relevance. B is faithful representation, which is about the measurement uncertainty or recognition inconsistency. Like, for example, what you do for deferred taxation. For deferred taxation, you see that it is simply an accounting mismatch that we eliminate through this deferred taxation thing. Accounting mismatch. Because according to the taxation department, this amount is not payable, whereas we assume based on our accounting criteria or accounting rules or principles that this is payable. So what we do, we put it as a deferred liability in our balance sheet along with the debit to the expense. So this is again a recognition thing that we do for based on which our financial information are more reliable, are more faithful. Okay, and presentation and disclosure also make it more faithful. So this is what the recognition is. Derecognition is very simple, that when the assets are no longer in the control of the entity, should be derecognized, or when they are disposed of, should be derecognized, means asset credit. And when liabilities are paid off or extinguished, liability obligation is settled, then that liability should be debited or derecognized. Now, this measurement is a very important concept. Measurement means that the value that we are going to give to the recognized head of account. All right. Value at which the information is debited and credited is measurement. Mostly it is historical cost, because historical cost is the value that exists at the date of transaction. This is historical cost. But IFRS gives us otherwise 3 more options, which are known as current value basis. So broadly speaking, there is historical cost measurement and current value basis. Mr. Fazal is saying that can we have this in recorded form? Yes, Mr. Fazal, and this lecture is being recorded, and the link will be shared with you, like in the group, and you can download that recorded lecture. This is for you. This is your asset, and plus the PDF of my slides will also be provided to you. Manur, better what you do, please quit and then re-enter. आपका जो issue है, this is unique to you. The others are easily getting me what I'm saying. Acha. Well, so okay. Yeah, current value measurement. Current value measurement bases are further 3. Fair value, present value. I call it present value because present value for asset is known as value in use, and present value for liability is known as fulfillment value. So you can call it as present value. And the third one is current cost. So broadly speaking, when we are measuring a financial information, that can either be measured at historical cost basis or current value basis. So this is the standard which will decide that at which amount it should be measured. For example, IFRS 9, which is about financial instruments, says that initially the financial instrument should be measured at fair value. In the same way, IFRS 41, which is about agriculture, means biological assets, it also says that biological assets should be initially measured at fair value. Okay. IAS 19, which is about employee benefit, it says that obligation of defined benefit plan should be measured at present value. IAS 2, which is about inventories, it says that the raw material inventory the NRV of raw material inventory is replacement cost. Replacement cost means current cost. And by the way, IAS 16 also gives the concept of depreciated replacement cost. Depreciated replacement cost. So means all these bases are used by certain standards, which are discussed in this IASB framework. So IASB framework is giving us a broader canvas on which like certain standards will be picking up the points for their own requirement, for the suitable for their own needs. Okay, so it is giving us just the guidelines. Well, factors to consider in selecting measurement basis. In fact, all this I have discussed with you. That, for example, it's very logical thing. In order to make the information relevant and reliable, relevance will be affected. Affected means negatively affected when characteristics of the asset or liability is specific to some certain nature, for which we are bound to use a specific measurement base. For example, we can never use amortized cost method for derivatives. Under IFRS 9, derivatives can only be measured at fair value. Can only be measured at fair value. We cannot use amortized cost method there. Okay. So relevance requires that this should be measured at fair value. Then this derivative should be or would be relevant to the decision making. Okay. Contribution to future cash flows. If assets are used into producing goods or services, then historical cost can provide relevant information. In that case, it should be measured at historical cost. Then it would be a relevant information about the margins achieved in the period. Okay. So historical cost for this type of asset would be more relevant. As to the reliability, means faithful representation, it is said that measurement inconsistency, for example, accounting mismatch, would be there if correct measurement is not. Like, let me give you a very classic example of IFRS 9. IFRS 9 about financial instruments. IFRS 9 says that you are borrowing funds and those funds are being utilized for making investment. Both of the liability and asset, like you are borrowing fund means there is a liability on you, and you are making investment means there is an asset. Suppose you borrowed 5 million from public, and that 5 million was made into an investment in equity shares of another entity, supposedly. IFRS 9 says that both should be measured at the same method. If this asset is being measured at fair value, this liability should also be measured at fair value. It will remove the measurement inconsistency. So in that case, the financial information would be reliable, or would be faithfully represented. Then measurement uncertainty. For example, too high value might make it necessary to consider selecting a different measurement basis. For example, your cost is getting too high, so that you say that it is not recoverable. Say it is not recoverable. So what you do, you calculate its fair value less cost to sell, or in a way, recoverable amount. Okay, or you revalue it downward to work out a value which should be presented in the balance sheet, just to make it faithfully represented or reliable. So it removes the uncertainty when we work out the information at its, like, this is the prudence concept, by the way. So enhancing qualitative characteristics are relevant to the selection of measurement basis. It is more about measurement basis, they enhance. The last point in this IASB framework is about capital maintenance. Capital maintenance means that the capital at the beginning date is maintained till the reporting date. There are two concepts in it: physical capital maintenance and financial capital maintenance. I'll explain it through a very small example. X Limited commenced business on 1st January with a single item of inventory, which costs 10,000 rupees. So most supposedly, like you had 10,000, you gave that 10,000 to the entity, cash debit, capital credit. The entity purchased an inventory debit, cash credit, and that inventory was sold for 14,000, cash debit, sales credit, and that inventory was taken to cost of goods sold, leaving a profit of 4,000. So simple income statement is that you have an income of 14,000, cost of sales of 10,000, profit is 4,000. And the balance sheet of this simple situation is that 14,000 cash is there because of the sales credit, cash debit 14,000. And that 10,000 was brought in as capital. And 4,000 is the amount of profit made during the year. Balance sheet is tally. So this is the concept of financial capital maintenance in money terms. Financial capital maintenance, your capital is maintained. Okay. Was started with 10,000 and now it is 14,000, means maintained. Should not be lesser than 10,000. Now the second concept, which is again financial maintenance of the capital, but in real terms. It says that during the year general inflation is 5%. Since general inflation is 5%, the owner assumes that his 10,000 capital should be maintained by adding 5% into it. Means it assumes that by after this 5% adjustment, the capital would now be 10,500. So it is saying that my capital should not be lesser than 10,500 because there is an inflation factor in the economy. So what the accountants will do, they will charge this 500 inflation factor in the profit loss so that profits will be reduced to 3,500. And this 3,500 will then be added into the owner's equity so that again, the assets are equal to the owner's equity. But by doing so, the profits have been reduced with this inflationary impact. So this is because of the general inflation. But if we talk about the specific inflation in the economy for the specific inventory item in which we are dealing, the specific inflation is 10%, specific to the inventory. So the owner believes that its capital would be maintained if 10% would be adjusted in its capital. So that 10%, 1,000 would be charged to profit loss as an expense in order to maintain its capital, which will reduce its profit down to 3,000. This 3,000 will become part of the owner's equity. And ultimately, again, its owner's equity is equal to 14,000 asset. So what we see that capital is maintained. By the way, still Pakistan is not hyperinflationary economy. Still, although it is like about 30% or something. Even then, we say that it is not hyperinflationary economy. So what we do, we prepare our financial statements, and mostly all the countries, they prepare their financial statements based on the capital maintenance concept, which is financial capital maintenance concept in money terms. Had it been like, God forbid, hyperinflationary economy, then the financial statements would be adjusted with the either general inflation factor or specific inflation factor, which will ultimately reduce the profits, but increase the owner's equity because of the inflation factor. So this is the concept of capital and capital maintenance in IASB framework. That's all for the day. And this is the summary of what we have discussed today about the IASB conceptual framework. For your quick overview, and I trust you will be like joining us for the upcoming sessions as well. By the way, as per the schedule that would be communicated to you, the classes or the proper sessions of our IFRS diploma will be started from the upcoming Saturday. This is, in fact, although it was a demo class, but in this demo class, I have taken up a very important topic, which is ISP conceptual framework. I have covered this. Now, in the next session, I'll cover IAS 1. That would be on 5th of August, inshallah. Do let me know if you have any discussion point. Ladies and tomorrow we will not have class, and a regular class we will be having from 5th of August, that is on Saturday, inshallah. Okay. Or otherwise, the management will be communicating to you regarding all the class schedules. So whatever the management communicates with you, we will be stick with that schedule. So that communication would be through the WhatsApp group, and I will share all these recordings in the WhatsApp group. Thank you. Thank you. So nice of you. Mr. Nadir is saying that, sir, is it possible to finish the class before 2 months? Mr. Nadir, the thing is that we have to cover almost 30 standards. Few of the standards are quite lengthy, and the schedule that I have developed for the completion of this course, it's like for 40 hours. When we say 40 hours, it means that we have to divide this into 4 hours in a week, and it would be 10 weeks program. Okay, if it is a special thing that we have to arrange, I can see if I could manage few of the weeks for 3 hours session. Might be then we would be able to manage our session within 8 weeks time period. We'll see.
3 घंटे तक to maintain the concentration.
Very difficult. This is something difficult. Yeah.
And I've just asked in the messages if you could possibly share the sort of the index or sequence in which we will cover the IFRS.
Yeah, definitely I'll share a schedule with you, in which mostly that is provided to the students or to the participants or to the trainees before the session. So what I'll do, once it is decided that the session would be from 5th or whatsoever the date, you will get the schedule through the WhatsApp group that would be for the registered participants. Okay.
और ये आखिरी बात मिस हो गई क्या, registered participants के लिए क्या होगा?
मैंने ये गुजारिश किया जी कि जो registered participants होते हैं उनका एक WhatsApp ग्रुप बना दिया जाता है।
ठीक है।
तो उनको जितनी भी कम्युनिकेशन होती है वो थ्रू WhatsApp ग्रुप होती है। That is the only way to communicate with our participants. तो वो फिर जैसे recorded lecture का link है, या ये अभी मैंने जो आपके साथ लेक्चर डिलीवर किया इसकी PDF है, वो मैं एक ही ग्रुप के अंदर एक ही मरतबा सेंड करता हूँ। तो जो भी हमारे रजिस्टर्ड पार्टिसिपेंट्स होते हैं, दे गेट देयर थिंग्स फ्रॉम दैट व्हाट्सएप ग्रुप। सो मैनेजमेंट जो इसके लिए आपके साथ कम्युनिकेट कर रहे हैं, वो आपको आपके नंबर्स वगैरह लेकर ग्रुप के अंदर शामिल कर लेंगे, और ऑल दैट कम्युनिकेशन वुड बी थ्रू दैट ग्रुप इंशाल्लाह।
ठीक है, ठीक है।
So thank you very much, Munir Saab and Iqbal Saab, for your feedback, and I trust the session will go very good with your active participation and active involvement. Okay.
Like a lot of questions in the chat.
हाँ मैं वही पढ़ रहा हूँ इस वक्त। Fazlul Haq Saab is saying, sir, which board
मेरा ख्याल में बोर्ड कहना चाह रहे हैं, वो कौन सा बोर्ड
will take the exam. इसमें IFA जो है वो एग्जाम लेगा, तो IFA में आपकी रजिस्ट्रेशन हो जाएगी. इसके लिए अगेन मैनेजमेंट विल इन कांटेक्ट विथ यू एंड you will have that communication. Lotsia is saying, I guess he was getting late. He said good night. Okay, Lotsia, good night. And okay, recording will be shared with you. Mr. Nader is saying, finished before 2 months. I have addressed this question. I will share this. I have discussed this question. Sir, which board? I have discussed this question. Nice to have sessions on SFU, Manur. And Munir sir, thank you very much. 𝐷𝐞𝐜𝐲𝐲 sir, thank you very much. Parvez sir, thank you very much. Fellow sir, is there any discount in fee? Management will do, inshallah. Just speak to management. Might be they will be considering you for the fee discount. Okay. So thank you so very much. God bless you all. Bye bye.
Allah Hafiz.
Allah.